Hello, ladies and gentlemen, and welcome to another installment of Thursday Thoughts. I'm Alex Leonida, the Chief Investment Officer at Capital Financial Group, and I really appreciate you guys joining me again this week. If you haven't subscribed yet, make sure you guys do that so you don't miss any of our videos. Once again, if you guys have any questions or anything that is top of mind that you'd like me to address, shoot them over to info@cfgfinancialplanning.com. As always, today we are going to cover important data. We're going to do some big news stories, at least ones that you may not have thought about. I'm going to take a question from a viewer, and then I'm going to close with my favorite final thought. All right, so let's get rolling. This week, there's been quite a few data points. If you watch the Monday Morning Minute, a couple of my favorites were coming up this week. And the first one is not really a favorite, but we talk about it every single week, and that's how we're going to start. We are going to jump into the jobs data. The jobs data hasn't changed a whole heck of a lot. Realistically speaking, everything is smoothed out in terms of the curve, right? This chart looks pretty familiar at this point. What's crazy is the news is touting a big downtick in continuing claims. And just as a refresher, that's the gold line at the top. I don't know about what you guys think, but that doesn't look like that big of a downtick. I mean, from my perspective, that line looks pretty flat. In all honesty, the downtick amounts to about 62,000 fewer claims this week than the previous week. And when we're talking over 20 million people, I don't know. I mean, that's not super exciting, at least from my perspective, right? I think the issue we're having here is primarily congressional leadership and some of their fiscal policy decisions that they're making. Right now, they're discussing shaving off a whole $200 from the weekly federal unemployment bonus of $600. So people are going to still get $400 more per week than whatever their unemployment insurance is to stay unemployed. I don't know what you guys think, but from my perspective, this is truly a scenario where I don't think people want to get off the couch to make less money. All right. If you guys remember from last week, we noted a few new line items from the DOL report. We kind of dug into things a little bit deeper. They release this like 11 or 12 page PDF every week, and hidden there in a fancy little chart on page 4 is those line items specifically underlining the pandemic unemployment assistance program. So since we started looking at that last week, we're going to do it again this week, and it actually rose by 70,000 people to a total of 760,000 if you're astute at math. It's pretty simple. That is a 10% increase week over week in people receiving that pandemic unemployment assistance program. That's a big number. And I mean, I don't know. It's a tough situation because I want to be optimistic. I feel like the news is trying to be optimistic, or it depends on which news station you watch. Excuse me. But in any event, the situation we're dealing with is pretty dire. I mean, the only number that should matter on that entire 11-page PDF that they release is the total number of unemployed people. And in this case, this last week was supposed to be a good week according to the news, but total unemployment dropped by 1.1% to 29,165,753 folks. I mean, that is a lot of people unemployed. If you remember from the Monday Morning Minute, I said we were going to talk retail sales. And now that we talked about having nearly 30 million people unemployed, you're probably saying, well, that's probably not great for retail sales. Check this out. All right. So amazingly, I know this is going to blow your mind, but the extra $2,000 per month people are burning a hole in their pocket generated the single largest monthly gain in American history for retail sales. 17%. I mean, I did this long period of charting for you guys so you could see how extreme this increase really was. I feel like this information falls directly in line with some of the data that we touched on a couple weeks ago. And I'm talking about the personal disposable income information. I kind of went on a rant on that. I mean, it was pretty mind blowing from where I'm sitting. It jumped from $16.5 trillion at the end of last year to nearly $20 trillion at the end of May or beginning of June. I mean, that is a lot of extra money in people's pockets, and they're not exactly saving it. I mean, this is saying that it is going from people's pockets directly to large corporations' pockets. People are not scared to spend money. I'm not sure what that means. I think, realistically speaking, we are probably banking on, as I use we as the collective of America, probably banking on more fiscal stimulus coming from Congress. It's an election year. We've touched on this. Nobody wants to make their constituents angry by withholding, and I think I think we're likely to see some more stimulus. So we'll have to see where that goes from here. But the retail sales and rate of change terms next month are going to be really telling if this was a 1 month massive spike or not. Next up on the list, we have housing starts. And just for fun, I actually Googled what the media was saying about this particular data set. Because historically, this wasn't awesome. But the media was definitely perceiving this through rose colored glasses. Market Watch, if you guys are familiar with them, they actually said, quote, housing starts climb 4.3% in May as buyers return and builders aim to speed up work. CNBC tried to be a little bit more real, but they had to fluff things just a little bit. They said housing starts miss expectations, but permits rebound strongly. I know this whole casting stones while you live in a glass house thing is frowned upon, but I'm just trying to deliver the data here. I mean, let's go back here. Let's look at this chart. All right, it probably just looks crazy, like a bunch of up and downs, but starts were down 23% year over year, and we had two consecutive record declines in April and in May. And every single time that we've had a decline of at least 10% month over month, at least over the last, I don't know, 10 years or so, that's happened 5 times. And every single time we saw the following month with at least a 10% uptick. I mean, we had 2 record setting down months and all we got was 4.3% this last print. I mean, I don't know. Relative affordability is as good as it gets, right? I mean, interest rates are as low as they're going to be. I mean, I guess they could go lower. Who am I to tell? But relative affordability of housing in the grand scheme of things is about as good as it's been in the last 20 years right now as we live and breathe. And I don't think this stock market is discounting this. So that's it for the data points. I know they were a little bit dry this week, but I think it's really important to look at this in terms of rate of change. And now that we've been doing this for a couple of months, we can start hitting on the same data points every month and see how they're changing. That way we know how to perceive this and what it could mean for the economy in the future. And more practically, we can kind of use this information to develop a thesis on how portfolios should be positioned. That's what I'm trying to do right now. I'm trying to empower you guys with data, how to read it, what it means, and how you should look at it in terms of your portfolios. So what we had next is big news. There's obviously a lot of news that is really important right now. And I keep saying this over the last couple of weeks because the news lines have been perpetually getting, I don't know, I guess it's getting overdone with all of the protesting and everything else. And we're missing out on some of the really important things that are happening from a geopolitical perspective and a financial perspective. It's easy to get lost in this stuff with how powerful it is. But each week we start with the updated COVID news or coronavirus, whatever you guys want to call it. We have right now is a continuing trend from last week. The top section here shows a couple of weeks ago we were showing lower lows and lower highs, which is good, right? That means that the curve is rolled over, etc. But everybody in the news is talking about how there's so many more people catching this thing, and the data is starting to at least prove that to be true. It's relatively speaking, it's hard to tell how much of a resurgence this truly is, or if it's just testing that is so much more ubiquitous that the numbers are a bit skewed. I mean, I really don't know. And I think honestly, it doesn't really matter. What matters is how the states are reacting to this. Um, at this point, if reopening slows or stops altogether, we're going to be in a situation where the market's going to react violently to the downside. Um, if the reopening continues as it's been going and state leadership and federal leadership kind of says, to heck with it, we're just going to keep the economy open. We're just going to see what happens. We're going to have to focus more on the daily deaths number, which has been slowly decreasing over time, which is a good sign. So this data is mixed right now. It's hard to read too much into it. But it's like I said, just to recap, more important to find out what the states are going to do in terms of the reopening of their economies, if they're going to put restrictions back on place. That's what matters the most to the market at this point in time. Um, Next up, we have actually kind of a cool statistic. I probably could have dropped this in the data section, but it was information that just came out this week. And it's actually how much dry powder is there out there. And that is a financial term. What I mean is how much cash as a percentage of the stock market is actually sitting in portfolios or in bank accounts. And Bloomberg is arguing that the cash levels that we're looking at right now are extreme and they could push the market higher because there's cash on the sidelines. But I mean, I'd like to point out the left side of this chart. I mean, if you look at where we're at right now, we're essentially at cash levels from back in, I don't know, 2007. Um, that was before things got really weird, right? Uh, Cash levels in 2008, when we had that first major reaction to the Lehman Brothers crash and the financial crisis, cash levels were much higher. And you saw that as they started to creep down, we had a little bit of a recovery towards the very tail end of 2008. Um, Everything got super weird in the beginning of 2009, and cash levels went through the roof. So I'm not saying that that is going to happen again. I'm not saying it definitively, at least. But what I am, I guess, offering up to you guys to think about is if things get weird, not a technical term, but if they get weird again, or we don't see this incredible resurgence of hiring that everybody says is going to happen, and business does not go back to the way it was, 4 or 5 months ago. What is this going to look like? Are people going to get scared and sell everything at the wrong time? I don't know. Only time will tell. But I did think that was a really interesting chart and some important news that was released this week. Next up is some geopolitical news. Uh, we have Southeast Asia information coming in hot. China and the U.S. are set to meet, I guess, this upcoming week in Hawaii. More specifically, it's going to be Secretary of State Mike Pompeo and Counselor Yang from China. They're getting together to hash out their differences. Depending on where you get your information, that could mean different things. I actually went so far as to look up some stuff on some Chinese news websites, and they're framing this whole meeting very differently than we're looking at it here in the United States. I mean, I'm sure China wants us to stop telling everybody that COVID is their fault, and we pretty much just want them to agree to stop stealing intellectual property. So I have no idea how this whole thing's going to turn out, but what I can say, and I can be really definitive on, is that we will have no idea what was actually discussed. Sorry, a little anticlimactic, but it is what it is. In other Southeast Asia news, we have North Korea back to doing North Korea things. If you guys missed it, they actually just blew up their nifty little meeting building designed for chatting up the South. They built this thing a couple of years ago, and it was supposed to be this big symbol of cohesiveness in the region and the fact that they're willing to talk and negotiate with each other. And they just decided to blow it up. Nobody really knows why. It was more symbolic than anything else. But historically, normally when this kind of stuff happens, it's just because North Korea is starving, literally, not figuratively. They want us to, or excuse me, they want to just cause a little bit of drama in the region and make things and shake things up a little bit so they can swindle some aid or try to force some kind of reduction in existing sanctions. Ultimately, this really doesn't mean anything to the global economy. So you're not missing much here. I just wanted to flag it because it's something that happened this week, and it was a little bit missed, I think, in the news coverage because North Korea has been relatively quiet over the last few months. So that's it for the news highlights this week, and it's time for the question of the day. I really love doing the question of the day. Actually, I wish you guys would send me some more questions because the stuff we've been getting has been really good, and I would like to have a wider swath to choose from, or I'd like to be able to answer more really solid questions. But I only want to do ones that I think that are going to be important to the most viewers. So if you send a question in and I don't answer it right away, I'm just trying to make sure that it's going to be applicable to a lot of the people that are watching. So the question this week reads, Alex, do you think the US dollar will get stronger or weaker? And how might the outcome affect me and my investments? All right. I'll answer it in two parts, right? So I think the dollar is going to get weaker. I think it has to get weaker. As we've discussed in the past, and I do in my quarterly videos, dollar strength is a relative beast, right? It depends on what the Federal Reserve's doing, what the European central bank's doing, what's happening in Japan, what's happening in Southeast Asia, et cetera. But right now, we are printing money like crazy. We talked about this last week in the rant with the Fed. I mean, there are trillions of new dollars out there right now as we live and breathe. Just trillions of dollars. Earlier in this video today, I talked about personal disposable income. Talked about it 2 weeks ago. I mean, there are trillions of dollars, and everything that we consume is denominated in dollars. Okay, so the second part of this answer is we're going to have to be creative on how we look at investing with a weak dollar as kind of a core staple, something that could continue for a while moving forward. Going back to the relativeness of currencies, we are printing a ton of money. Europe is not. Okay, so inherently the dollar will weaken against the euro. The dollar will weaken against the yen, etc. When this happens, commodity prices, consumables, this is going to be foodstuffs, it's going to be energy, anything denominated and traded in dollars would theoretically appreciate because what it's denominated in would be lowered in value, thus increasing the price of the good. So that's how I think we should look at it in terms of investing. We need to look in places where there's a good risk return profile and things that actually benefit in a very weak dollar environment. I'm not going to give you specifics on that because I'm not supposed to, but if you want to reach out to me, I can do it one-on-one and talk about my ideas in that space. All right, so for the final thought, one of my favorites, and I actually skipped one of these things again. You guys know I'm not the best at getting up the slides, but my final thought is my favorite thing to do. And this one's actually stemmed from another question that I've been getting in client meetings, that I've had in casual conversations, and honestly, it creeps into me just a little bit. And the question I have is, why does it seem like the market wants to keep going up forever? This is a highlight that I've seen on CNBC and everything else, right? So historically speaking, it kind of looks like it does go up forever, right? Let's take a look at this right here. This is the Dow going back to probably before anybody that could possibly function a computer was born, realistically. But I mean, this looks like it does go up forever. So the question is valid when you look at it over like 100-year time period. But what we're experiencing right now, realistically, I think is just a condensed market cycle. I mean, look how violent the moves have been. It's so aggressive that you can barely see the down and up all the way in the top right corner. I mean, the old adage is, the stock market is a forward-looking indicator, right? It's supposed to depict where the economy is going to be 6 months in the future. That's kind of the standard thought process. The swiftness of this decline, which I think was justified given the data and the insane subsequent recovery, that was that little blur on the right side of your screen, has proven to be a lot for people's emotions. I mean, that's what's driving that question, right? Will the market go up forever? Um, I mean, honestly, what we have is a handful of stocks right now, five to be exact, maybe six that are driving this recovery pretty much all by themselves. Just being a good boy for compliance, I'm not going to talk about specifically what those stocks are, but the five biggest companies in the S&P 500 account for more than 20% of the market cap. All that means is the bigger the company, the more of an impact it has on the index. To make my point crystal clear to you guys, the S&P is nearly flat on the year as an index. But if you look at the index as being equally weighted, or that size doesn't necessarily matter, the S&P would be down over 10% year to date. In other words, the stock averages, or excuse me, stock averages, the average stock in the S&P 500 is down over 10% for the year. Yet the index, the way that we look at it on TV, is flat. The whole point of what I'm trying to say here is that most stocks are down. It's the headlines that are driving the question that started my final thought. And and frankly, it's people's fear of missing out that blurs the reality that the stock market isn't all butterflies and rainbows. I mean, this recession is real, okay? And I intend to treat it as such. Our firm intends to take it seriously. And I'm not going to submit to this FOMO or the fear of missing out. And I'm going to continue to be research driven and data driven in every single decision I make for client portfolios. And every piece of news that I bring to you guys is going to be unbiased. I'm just going to give you the real stuff. And when we get done with it, I'm going to tell you how I feel about it, because I think it's important to get a view that's not skewed or trying to drive you to your own conclusions. So that's what I got. That's what I got this week. And I know I'm hammering on this stock market thing and how overvalued it was. I talked about it last week. It's just a very, very real situation that people might not be seeing through the right lens. So that's why I wanted to go there again this week. As always, thank you guys so much for joining me today. I love the opportunity to share my videos with you, and I hope you all get something out of these videos. Don't forget to like and subscribe right down here. I don't want you guys to miss any of our content, and remember to check out CFGU. Cole has been coming up with some really cool videos talking about retirement plans, and he's working on a whole bunch of other awesome content for your viewing pleasure. Also, please send me questions. I would love to have some more questions to answer. Send them to info@cfgfinancialplanning.com. And until next week, in honor of this unseasonably cool weather we're having out here in the middle of nowhere in Colorado, I'm having a scotch. So cheers. I hope this was a great way to start your Thursday happy hour. Talk to you guys soon. See you next week.